Hello, everyone. Great to connect. I hope you guys can hear and see my screen clearly. I'm getting a little feedback. If anybody else is getting that, please put it on the comments, otherwise we'll get started. Okay. So I have the task of presenting algo trading and what is the impact on the markets, as well as how new traders can understand and develop their own strategies in this world. I'm going to be presenting on algo trading in India, a guide for new traders. First, a quick introduction about me. I run a company called ST Capital. We have high frequency trading and broking businesses in India, Brazil, US, and 11 other markets. We are primarily HFT and algo traders. So we use a lot of machine based learning. We use a lot of algorithms to do trading in all kinds of securities around the world. And what I'd be talking about is a beginner's view on why is it important, how big is it become, and maybe give you some ideas on how you may want to get started in this world. So let's get started. First, let's talk a little bit on introduction and agenda on what I'll be talking about. I'll be talking about introduction to algo trading, growth in India's market specifically. I believe that more than half the viewers are from India, so I picked that up. Automation for retail traders, what's happening, what can be done, and I'll specifically talk about one particular product that we have built, which is as a case study that can help you understand what is possible today. What are the risk and compliance angles with that, and what do you need to understand as you do this safely? So let's talk about algorithmic trading. Now it's a big topic. I only have about 17 minutes in the scheduled time or so, so I'll try to cover it quickly. The first thing to understand is you have to do two things that algo trading does better than manual trading. The first is it's algorithmic. That means there is no chance of making any error with what you want to do. As long as your code is correct, you will always get the orders in the way you want it. There is no fat finger error. There is no computational error. There is no error in terms of I saw a price, but it was really something different. Those kinds of errors get completely eliminated because everything is fully automated and everything flows through seamlessly your system. So you have direct market access and you have the ability to tell software to what to observe and how to trade. The second benefit is latency. Now, latency benefit has to be understood in context. When I started building out this company in 2008, particularly in India, algo trading was not even legal before 2008. And there used to be thousands of people in Mumbai and in Delhi whose sole job used to be sit with two terminals open. And sometimes they used to trade in a pair. One would have a cash market, the other would have future markets, or one would have NSE, the other would have BSE, and they would do manual trading to find arbitrage opportunities between these two markets or positions. Today, that trade is almost fully eliminated. It's impossible to do that manually. Why? Because machines can do it much, much faster. To give you a perspective, the fastest human being cannot react in less than about 15 milliseconds. That means it takes them, they're fast. It's less than a second, but it's still 15 milliseconds. And our algorithmic systems, which are co-located, react to the market events in less than 1 microsecond. Now, microsecond anyway is 1,000th of a millisecond. So we are talking about 15,000 times faster in what a machine can do versus what the fastest possible human being can do in terms of hitting that button, and then there'll be still latency for the order to go through. So you're talking about at least 20,000, maybe even a million times slower if you're trading manually versus if you're trading using the fastest computers algorithmically. That benefit comes, one, from the automation of the software, and the second part is it comes from co-location. Our machines and servers, and for most algorithmic traders, they are located in the exchange. That means the message from our server to the matching engine goes directly to the exchange. It doesn't go through the internet, doesn't go through a long distance. You may be sitting in Calcutta or you may be sitting in London, but the instructions are still going from BKC's, NSE's office to NSE's servers right there, very, very fast. So that's the benefit and the most important aspect of what happens in algo trading. Now, what has been growth of algo trading in India? If you look at the various segments, these are large. The largest segment is equity derivative segment, which is 40 lakh crores. So that would be about 5 billion turnover. 40 lakh crores is the turnover on average for equity derivatives. Commodity derivatives are a little smaller. Currency derivatives are sizable, and cash market is about half the equity derivative size right now. Now, within that, the penetration of algorithms is about 60 to 73%. And that means that of all the trading that's happening, about 60 to 73, 75% of the algorithms contribute to what is the total amount of trading that's going on in the markets. Let's talk a little bit about managing the risks and meeting the regulatory requirements for algorithmic trading. So first, the biggest risk in algorithm trading is that the speed is so high that before you realize, if the software is not operating correctly, you may find yourself in very, very dangerous situations. So the speed is a two-edged sword. On one side, it gets you all the execution, and the second side, it gets you all the execution even if you did not want it and made a mistake. So it can lead to over leverage. It can lead to failures of handling the market flow and getting into a complicated situation that you don't fully understand, because there is so much trading that happens in very, very small intervals. There have been famous stories of algo based failures where Knight Securities, a US based company, lost over 240 $50 million within half an hour because the algorithm was pumping orders in one direction because of a simple error in the entry of parameters that had been done. The second is regulatory compliance framework. Now, fortunately, especially in India, the SEBI regulator has come up with a framework which allows people to participate in algorithmic trading, even if you are a retail trader. So what it says is, if you're using a algorithm that is what's called a white box algorithm, meaning the details of the algorithm are fully known, then you can buy that algorithm from anyone, use it. If you are using it at a speed of 10 orders per second or less, you don't need to do anything. Anybody can use any kind of automation to do that kind of a trading. If you're using faster speed, or you're using an algorithm that you don't fully understand but you license it from a provider, then the provider has to be regulated. They have to have an RA license. That means they're providing you a research product for helping you trade. Now, if you get an algorithm from a provider which has that license, then you are good to go. It can be a black box element, it can trade very fast, and if you can find a broker which is willing to host you on a co-located server, then you can also get benefit of trading directly on the exchange using an algorithm provided by such a regulated entity. That would be completely legal, safe, in the sense that these are the boundary conditions that have been defined, and SEBI has put in a lot of conditions on what kind of risk checks have to be there, what has to be true for you to be able to provide these kinds of algorithmic trading, including auditability, including all kinds of parameter and guardrails for what risk the algorithm can or cannot take. Now, I'm going to talk a little bit about a product we have built for this purpose. It's called S-Trade. It implements these kinds of safeguards like position limits, circuit breakers for losses, what is the maximum risk that you are taking. And many of these are regulatorily required. And some of them we have built on top of it to provide even more granular control, both in terms of the risk requirements and profitability requirements. Sometimes you want to activate and capture the opportunity quickly. So we give you a parameterized way of going after the opportunity while staying within the risk and compliance framework that SEBI has set up. Talk about automation platforms. So as I mentioned, there are a bunch of retail tools that are now coming up, but some of them can be internet based. If they are internet based, then you are only getting one of the two benefits. As I mentioned, one benefit is you have full automation, so you can write the logic of how you want to trade. But the second benefit of algo trading is latency. That means you get your order execution fast. Now, the internet based retail tools will only give you the automation benefit, they won't give you the latency benefit. They are generally cloud hosted and don't have predictable latency. They will be order of magnitude in milliseconds if they are very, very good. Typically, they could even be in a second kind of a latency to get their order done. Now, if they are don't have to be non-compliant with SEBI, but you have to be careful to check if the algorithm is what's called a black box algorithm and can trade more than 10 orders a second, it must be regulated under SEBI's rules today. The risk controls and monitoring has to be strong. You should be able to set limits in terms of what are your profit limits, risk limits, trading limits, how much orders, how big in orders can you provide. The institutions in the meantime are providing co-located DMA microsecond executions. They have very robust risk engines and they are fully regulatorily compliant. So the result for retail trader is there is a major technology and compliance gap between what retailer has available to them easily versus what an institutional prop trading desk or an HFT company is going to be using. I'll give you some examples of type of trading that you can do using algorithmic trading. So the first very easy example is cash future arbitrage. In India, there is 3 lakh crores of capital deployed in cash future arbitrage, which simply trades between the future and the cash element. And if the spread is more than a certain amount, you can trade it. Now, this is something very easily automatable. You can put it in an algorithm, you can put your parameters of what to track, and as soon as that parameter is satisfied, meaning let's say you set the parameter that if I'm getting more than 1% arbitrage between cash and future price, I'll trade. So I'll buy the cash, I'll sell the future, lock in the 1% profit, and that is the trade I want to put on. Index arbitrage is another example, which is much more complicated, but still the principle is the same. In this, you are trading Nifty on one side and trading the 50 components of Nifty on the other side, or you're trading Bank Nifty on one side and it's 12 components on the other side. Same thing with Sensex and its components. So you have to trade them in a specific ratio of what is available to replicate a index exactly mathematically truly. If you do that, you have no more risk, which means that the trade is exactly matched in terms of its value, and therefore you can hold it without any risk of divergence from the underlying price. Option ratio trades, this is also something that a lot of people automate and trade regularly. In this case, a butterfly or all kinds of combinations of different puts and calls at different strike price are created, and if they are done in certain ratios, they have different attributes in terms of what profits we will make if the market moves, goes up, goes down, or simply moves, 1% from its current price. You may end up making money. So the ratios in which you trade, you can set and automate in an algorithmic trading platform, and that will capture the multiple legs you need to execute whenever those conditions are met, that certain price spread is available in a particular ratio of the trade. So these are just some of the examples that allow you to trade algorithmically. Now, the S-Trade product that we have created gives you that institutional grade infrastructure. It gives you the co-located infrastructure to be able to trade. It gives you microsecond latency. Depending on what type of algorithms you set, your micro latency will be about, let's say, 10 to 15 microseconds to get the order out from your system. So not quite very fast as if it was fully developed as an HFT system, but still 1,000 times faster than what an internet-based system or a human-based system can do. It is fully compliant with the SEBI's regulation. It has a no-code strategy builder. That means you can point and click on a screen and set up all the parameters you need to be able to trade. The multi-exchange and monitoring capability allows you to look at NSE, BSE, MCX, other possible exchanges, and you can then set up different dashboards to be able to monitor various spreads on things that are going on in these markets, and set parameters to be able to trade specific combination of those prices that you're monitoring at any given time. So those are some of the features that are available to you. I notice I'm starting to get some questions. I'll try to address them. The biggest failure or setback you've seen in algorithmic strategies, and what did it teach you? So I can tell you both globally and within our firm. Within our firm, we observe anything where there is a potential loss of more than, about $1,000. If something happens like that, we track. Every year we may have such instances which may go up to several tens or even hundreds of thousands of dollars, starting with $1,000. Maybe we have 1 to 12 instances like that in a given year, but we have never had anything bigger than that. When something like that happens, we go through detailed root cause analysis. It can be any kind of a corner edge case. The most extreme example I can tell you is we had written a piece of code with C++, and in C++, the memory overwrite can happen. And the way we were writing something, it overwrote another part of the memory that was not very tightly controlled, which resulted in algorithm believing the price to be something different than what it was and trading a lot more. And that created a sizable loss for us, several tens of thousands of dollars. But that's something that very, very difficult to predict or prevent. The way it got stopped was certain limits were hit in our system to say this algorithm is losing too much money too fast. So it was shut out automatically. So those kinds of risk controls have to be there, but we still lost a lot of money, and it was a failure of the software development and quality control check. In terms of global failures, I mentioned Knight Securities. It's a market making company based out of Jersey City in US, and it lost, I think, $260 million in a span of half an hour because it was constantly pumping a lot of S&P orders when much more than the money it had and the order it wanted to execute, about 1,000 times larger. And as it continued pumping those orders and then tried to recover from it, the price had fallen so much that by the time they could recover from it, they had lost a lot of money already. Because the market starts, kind of moving against you. So if you have to cover and if you're, for example, selling, then the price is constantly dropping. The more you sell, and then when you try to recover, the price starts recovering very fast, and you end up making a big loss in the spread that you had incurred. That's one of the largest failures of algorithmic trading. There are others, one of which was one of the big order in one of the Diwali trades in India about 10 years ago had a similar issue. A large order was entered and it was trading algorithmically and created a big problem. There have been other instances all around the world, which if you Google, you'll find dozens of cases of algorithmic issues, mostly around some miscalculation, misentry, wrong parameter being set up in the trading software. Generally, it's not the software's problem, it is the human who's managing the software that's an issue. Edge in algo is shifting towards innovation in models or infrastructure. Both go hand in hand. Innovation in models is the larger innovation. Innovation in infrastructure and technology is the smaller part, but it is intensely profitable for people who focus on it. So typically, the companies who are very good at the infrastructure and latency management make good amount of money, but orders of magnitude, they'll be making hundreds of maybe tens to hundreds of millions of dollars in aggregate. But the models make much, much more money. They would be making money in aggregate on hundreds and millions to a billion. So at least an order or two orders larger. But the profitability on deployed capital will be much more if you have a infrastructure or latency advantage. As the algo trading becomes more powerful, what ethical and regulatory challenges should the industry be prepared for? I don't see there are any ethical challenges. This is like any other automation in the world. It creates a category of people who have invested in the technology and can do trading faster and therefore more profitably than somebody who is not invested in technology. But that's a competitive thing. The technology is freely available for anyone to buy and develop. It's a question of investments. If we were to say, is there an ethical concern between flying between Delhi and Mumbai and going by a bullock cart? Of course, there is a huge difference. You cannot compete and compare the two things. But as long as access to air flights is available to everyone, there are no ethical concerns that I see. There are obviously regulatory challenges because the regulator has to now do a lot more to make sure that they understand the very, very large volume of trading, large volume of data that comes in. There's a famous or notorious case of Jane Street where SEBI has fined $500 million to Jane Street and have provided a very sizable show cause notice saying these are the things you were doing which are illegal in terms of manipulating the price of cash securities and benefiting by trading in the option world. So the regulatory challenges will continue to grow because, like any other technology, when you have a powerful technology, the potential of doing harm also goes up dramatically. What are the most overlooked technical risks in deploying algos in live markets? I think the most overlooked risks tend to be what real time monitoring of risk is generally overlooked. People have too much faith in their own ability to be able to write things in an error free way. In good companies, for example, in our company, the teams that develop the algorithms to trade are completely separate from teams that develop the risk management system and have an independent control of shutting down should anything go not according to the boundary conditions that have been set for trading. And this is, I think, this thing in individual trader that's not possible. You can't say my one arm will write the code, the other arm will do risk control. So you need a partner which can help you do the risk control for you. Misconception about algo trading that you hope to break through my book. My book is not really about algo trading. My book is really about investments broadly. And the myth that I wanted to break was that investment is neither easy nor difficult. It is a system that needs to be followed. And if you understand the few basic rules, then you will do better than the average investor for sure. So that you don't need to be a day trader, and you also don't need to be completely ignorant, and the alpha that you are going to make through investment is very, very large. You'll probably end up having 20 to 40 times more retirement money if you invest it properly versus keeping your money in fixed deposits. What are you focusing in 2026? How are you using AI? We use AI extensively for analyzing companies, for developing software, for building a robo advisor for advising people in financial advice. So these are all the things that we're doing in our company using AI. Are you hiring more traders or developers or engineers? We don't really hire any traders except trade monitoring people. We basically work with developers and engineers. Okay. Some key takeaways. Algorithmic trading is a necessity. It is a way of making trades efficient. It provides value in the society because for people who are wanting to buy and sell, they get better liquidity and faster liquidity if algorithmic traders and market makers and arbitrageurs are present in the market. Think very simply, let's say you live in Mumbai and somewhere in wherever the Alfonso mangoes are grown versus in Andheri or in Malabar Hill, the price of mango is going to be very different. But there has to be a trader available who is going to transport that mango from the fruit growing region to the consumption region of Malabar Hill, and the better technology, refrigerated trucks or faster trucks that are available, the better it is for the overall ecosystem. Both the farmers get a better price as well as the consumer gets a better price. Same things happen with liquidity. If you want to buy a share in NSE, you have to have somebody who's willing to sell you the share. And if the price in futures market is more advantageous, then let them do the arbitrage of taking the liquidity from the futures market and selling you the share in the cash market so that you have that availability right away. So algorithmic trading serves the society's purpose of providing liquidity, taking away arbitrages that are available in the market. Institutional grade platforms are now becoming available to retail traders. So when you are deciding to trade using algorithms, you must evaluate them for latency, for automation, how much coding you need, and is it fully compliant, both in terms of SEBI requirement as well as risk management. Is it going to meet all those needs or not? Risk and regulation vigilance is very important. A lot of people have gotten into trouble by scaling up and participating with under the radar type of algo providers who were not regulated and promised uh, the sun and the moon to investors from their software, which they were not able to deliver because it's not easy to make money even though you have algorithms. So that's a separate topic on how do you actually trade, but don't trust things like that. Unlocking new opportunities are definitely possible. The trading will continue to grow as the algorithms continue to build out. I think my time is up, so I'll close with this chart. This is my book. It's available online in US. It's available in bookstores and on Amazon in India. And you can scan my QR code and send me an invite on LinkedIn. I'll be happy to connect, and you can ask me questions if you'd like there. I don't know if I have any more time, Sneha. There are a couple of questions here that I can address. Or if you're done, then thank you very much.
I would love to actually have this session go on for a few hours more because there's so many things I can take away, and I'm sure the attendees are also taking away with a lot of golden nuggets. But unfortunately, we are up with the time. So for this time, we'll be wrapping up this session. Again, once thank you so much for making time, Sandeep, and joining us, and for such a wonderful and impactful session that you've sent us.
Thank you, Sandeep.
Thank you.
Thank you so much.
So I think we've come towards the end of our online session. I just wanted to jump on quickly and say thank you to you, Sneha, for being the hostess for the day. I think it was terrific and you did a fantastic job. Obviously, thank you to all of our viewers, everyone who logged on from around the world. and stuck through the sessions. I think there was some real gold in there. If you were, for everything that you wanted to learn about the markets. Thank you to all the speakers. We know you've taken time out of your valuable day, and especially thank you to Tick Mill, who was our sponsor for the day. So if you enjoyed this, if you feel like you've learned something, make sure you subscribe to our mailing list. You'll hear all about our upcoming events, which I spoke to a little bit earlier. So Sneha, just tell us, what do you think was your favourite session?
Well, that's a very difficult spot you're putting me on, Paul. But I think the session with Jason and Hemal was one of my favorites. The
Yeah,
fireside chat. I think it was quite open, quite honest. Personally, myself not being from the industry, I have learned a lot of things that I never knew before, and it's just great to hear their personal stories with how their journeys have been. So yeah,
yeah.
I think that would be my.
Awesome, awesome. Well, my personal favourite was obviously my own. But on a more serious note, I think with my sort of little bit of a techie background, I really enjoyed the session from Magmio, talking about how to shave nanoseconds off your response times, which was really quite insightful and really interesting. Having been involved in setting up exchange data centers for co-location, I just thought this was a really fascinating innovation that they're bringing to the market. But really, all the speakers were terrific. We've had a great time today, and I hope you enjoyed it too. Thank you, everyone. Thank you for joining.
I did, and I hope our attendees enjoyed this as well. Last but not the least, I would also like to thank our Arjun Global team, who've put in a lot of efforts to making sure that this event runs smoothly. So thank you for everyone who's come together to make it possible. And if our team can help us just put up the QR codes, so everyone who would love to know more about Arjun Global, what we do, want to learn anything around financial markets, please do make sure that you give us a follow and subscribe to our mailing list. I do hope that we can see you very soon again. So thank you so much and have a great evening.
Thank you, everyone. Bye bye.